A very happy day to all of you. This is the YouTube channel Banking Fundas, and I'm your learning partner, Sushila Hariharan. In this module, we're going to take a detailed look into the functioning of a new and emerging type of bank called as small finance banks. These banks were established a few years ago, and today they have become a very strong competitor to traditional banking. So in this module, we'll have a detailed analysis of what it is that small finance banks do. Traditional banking focused extensively on the traditional role of banking, which has largely been as a financial intermediary. So what do we mean by intermediary? An intermediary is an entity that comes and brings together two institutions or two entities that have something in common. So banking is the largest financial intermediary in the world because they bring together entities that have surplus of capital and entities that need capital. So as a financial intermediary, banks accept deposits and they disburse loans. These are the primary functions of a bank. When they accept deposits, they accept a variety of deposits: savings accounts, fixed deposits, term deposits, recurring deposits, NRE accounts, etc. And when they disburse loans, again, they provide a whole range of diverse spectrum of loans are granted to both corporate as well as retail borrowers. So in this function as a financial intermediary, banks perform a very important role, and that is the role of moving capital from those who have it to those who need it. Okay. The fourth most important function that the banks do is facilitating payments. Increasingly in the world, and especially in India, ever since the events of demonetization have taken place, as well as the recent pandemic, digital payments has become the new trend amongst many of the retail customers. Banks traditionally also were involved in facilitating payments. If you recall, many of us have issued checks. Many of us have issued demand drafts, bankers' checks, etc. So there was a very robust paper-based payment system. Now, many of these payments are going digital. We have a separate module on digital payments, which we'll be discussing as a separate module altogether. Traditional banking also focused on facilitating FX transactions. By FX, we mean foreign exchange. Foreign exchange is conversion of one currency into another currency. This conversion is largely used by people who travel abroad, by corporates who have export-import businesses, corporates who have taken loans in foreign currency, corporates who have parents as foreign-based companies, etc. This movement of foreign exchange across the world is legally permitted only through the banking channels. And therefore, banks have this big responsibility of enabling FX transactions. Banking also focuses on facilitating global trade. Global trade depends entirely upon movement of goods from one country to another country, from one continent to another continent. And this global trade is financed largely by the banking system. In a separate module, we'll be discussing about letters of credit and how global trade has gained such a great importance in the last few years. But that was traditional banking. So what was the gap that was there in traditional banking that compelled RBI to introduce a new type of banking entity called small finance banks? From this slide, it looks like the traditional banking was covering all aspects of financing. So what was it that was needed? What was it that was required that RBI felt was important to enable future growth of banking? And that is the small finance banks. In this module, we'll be referring to small finance banks as SFBs. RBI identified that a large percentage of Indian population was not served by the big banks. Despite having a very new focus on financial inclusion, there has been a large part of Indian population which is underbanked, and a large part of Indian geography which is unbanked. This led to the unorganized lending sector growing very large. These include your local money lenders, the pawnbrokers, entities who would charge close to 35-40% per month for giving small loans to those who need it. Farmers, day wage earners, gardeners, fisheries, etc. So this unorganized credit sector became very large, and their lending practices were completely unregulated. If you have watched enough of movies, you know that if the borrower doesn't pay back the money, they send big fat bouncers to the house and tell them to recover the money, right? Therefore, this organized sector became really large, and that's not good for mainstream banking. We can't have mainstream banking servicing only the large corporates or the well-to-do population, whereas a large part of the population and districts continue to remain unbanked, or even worse, banked by extremely unscrupulous, illegal, unethical, unorganized sector. It was very tough for individual businesses to get loans. Keeping in mind that financial inclusion is mandatory, and everybody has a right to banking, like how we have right to education, right to information. The individuals as well as corporates and businesses have a right to banking. They should be allowed to bank. RBI set up the system of small finance banks. The main capital structure of the small finance banks was clearly enumerated by RBI. They say that only fit and proper promoters can start a small finance bank. So this is a very new term that was introduced by RBI when they spoke about who should be the promoters. Fit and proper. Fit and proper means the people who start the small finance banks should have a legacy of having worked in banking. Okay, you cannot suddenly start a bank without having any experience in either banking, non-banking finance companies, microfinancing institutions, etc. So promoters should come up with a good qualification and work experience. And on the basis of that, the RBI will consider granting a license to such a banking entity. The minimum capital that the banks have to start with is 100 crores of net worth. Since it's just a startup bank, the net worth would almost be equal to the share capital. Out of this 100 crores, 40% has to come from the promoters. So if they start with 100 crores, at least 40 crores should have come from the promoters. That being the case, the banks have to be very clear in their understanding that the small finance banks is starting their operations with a good quantity of capital. Within a period of 5 years, the net worth has to be increased to 200 crores. So therefore, you start the bank SFB with 100 crores by banking professionals, by finance professionals, and quickly within a period of 5 years, either through an IPO or a private placement of equity, the net worth of the bank should increase to 200 crores. Within 3 years, it is expected that the SFB will do an IPO or a primary issuance of equity. In India, foreign direct investment regulations govern foreign ownership in banks. That is, FDI holding of more than 74% is not allowed in banks. This regulation also applies to SFBs or small finance banks. So if you go for an interview, there could be multiple questions on this capital structure itself that could be asked. Somebody could throw a googly on you and ask you, okay, here is a person who is having experience in coal and mining. Can he start a bank? Yes, if his team members have enough of experience in the banking industry. Here is an entity who has 25 crores of net worth. Can they start an SFB? The answer is a big no, they cannot start because you need 100 crores to start the SFB. So there are multiple questions that could come around this capital structure itself. So get this fundas very, very clear. Who is a fit and proper promoter? What is the net worth of the bank at the time of starting the SFB? Within what time period should they do an IPO? And what is the foreign direct investment regulations? How much can HSBC Bank own 80% of Ujjivan Small Finance Bank? The answer is no. HSBC Bank sitting in Hong Kong or UK cannot own 80% because that comes under the FDI restriction that not more than 74%. So on these 5 bullet points itself, a lot of questions can be asked to you and you should be prepared with the answers. In India, the banking operations of small finance banks are governed by RBI. So RBI is very clear, which says that 25% of branches should be in unbanked rural areas. If you look at it today, some of the small finance banks have more than 25%. So this is the minimum. It is minimum 25% of the branches should be in unbanked rural areas. On the other hand, 75% of the loan portfolio should be given to priority sector loans, PSL. Now, what do we mean by PSL? Priority sector loans are loans that are granted to primary sector. Okay, this primary sector includes fisheries, metallurgy, agriculture, self-help groups, etc. So now in point 1 and point 2, the RBI is addressing the need for catering to the underbanked geographical areas and the unbanked population of the Indian public. The third criteria is 50% of the loans portfolio should comprise loans of up to 25 lakhs. That means if the bank starts off with a capital of 100 crores, it cannot give all the loan, the entire amount as 90 crores by way of loans. Okay, because that 50% of the loans portfolio should comprise of loans up to 25 lakhs. Small ticket loans is the focus. So if you want to achieve financial inclusions, we have to work towards unbanked, underbanked, loan transactions, loan size, and what should be the loan volume to the priority sector lending. So remember this point, PSL is priority sector lending. Small finance banks have to also mandatorily maintain CRR and SLR as prescribed by RBI over time to time. Okay. Now that we have taken a look at the capital structure, it is very important to remember that the maximum loan size is also prescribed by RBI. Whilst the RBI says that 50% of the loans disbursed by SFBs must be up to 25 lakhs, the maximum loan size should be 10% of capital funds to a single borrower and maximum 15% to a group. So the bank has to give a loan give loans as per this requirement, as per this mandate. That is maximum 10% of total capital funds to a single borrower and maximum 15% to a group. SFBs cannot do a big long list of what SFBs cannot do. SFBs cannot lend to big corporates. Big corporates will take loans of 500 crores, 1000 crores, etc. SFBs were not formed for that. SFBs are supposed to give micro loans, small size loans, and therefore they cannot lend to big corporates. During the first 5 years of setting up operations, every branch that is opened by an SFB has to have RBI's prior approval. They set up subsidiaries to undertake non-banking financial service activities is also prohibited explicitly by RBI. SFBs cannot act as a business correspondent of any bank. In a separate module, we'll be taking a look at correspondent banking and what it means to the banks. So now that you've taken a look at what is the capital structure, what is the loan size and quality, as well as what are the restrictions imposed on SFBs for lending. Some of the large SFBs in India are FinCare, Capital Small Finance Banks, Equita Small Finance Banks, Suryodaya, Jana Small Finance Banks, AU Small Finance Banks, Jeevan also is there. Many of them have done an IPO and are also listed on the stock markets. That brings us the favorite part of the module, and that is a little quizlet that you must answer so that we know whatever we are read, whatever we are understanding is sound and will be retained by us in the future. What percentage of SFB's loans should be to priority sector? Should it be 25%, 50%, 75%, or 100% of the SFB's loans? Absolutely right. The answer is 75%. Dash percentage, what percentage of an SFB's loan portfolio should be for amounts up to 25 lakhs? 100%, 75%, 50%, or 0%, no restriction. Think about it. We have discussed this point over here. Right? Very good. And the last one. As small finance banks are small in operations, they do not have to maintain CRR or cash reserve ratio. Is this false or is this true? It is indeed false. They have to maintain the cash reserve ratio. See the twist in the question. They do not have to maintain CRR. Is it false? That means they have to maintain. Okay. So there's a twist, two negatives. They do not have to maintain and not true. So they have to maintain CRR irrespective of the size of operations. With that, I come to the end of this module. Please review these questions again before you go for an interview so that you are well equipped to answer questions on small finance banks. Thank you so much. I'm honored to have been your learning partner today. Thank you.